Ladies and gentlemen, good day and welcome to the Q1 FY23 earnings conference call of Schneider Electric Infrastructure Limited, hosted by Elara Securities Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star 10 on the touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Harshit Kapadia from Elara Securities. Thank you, and over to you, sir.
Thank you, Margaret. Good evening to everyone. On behalf of Elara Securities, we welcome you all for the Q1 FY23 conference call of Schneider Electric Infrastructure Limited. I take this opportunity to welcome the management of Schneider Electric Infrastructure represented by Mr. Sanjay Sudhakaran, Managing Director, Mr. Mayank Holani, Chief Financial Officer, and Mr. Vinit Jain, Head Investor Relations. We will begin the call with a brief overview by the management, followed by a Q&A session. I'll now hand over the call to Mr. Sudhakaran for his opening remarks. Over to you, sir.
I'm Director for Schneider Electric Infrastructure Limited, and I'd like to welcome. This is Sanjay Sudhakaran. I'm the Managing Director of Schneider Electric Infrastructure Limited. I welcome all of you. A very good afternoon to all of you, and I welcome all of you to this earnings call, please. So, without much ado, I will go straight to the presentation. If we go to the slide number 3, which is page number 3, we will briefly talk about the economic outlook of the country. As you can see that the GDP forecast for the country has been slightly brought down from the earlier bullish outlook that we had. This is primarily due to there are concerns regarding the global situation. Inflation in certain countries are very high. There is fear of an economic recession, the Fed's increasing the rates, etc., and also a feeling of reduced consumption in the rural economy in India. However, I would say that the demand pattern continues to look strong in terms of our segments, which we will talk a little bit later. So we assume that these concerns around the global situation, etc., would fairly leave India untouched, at least for a few quarters from till now. That's what our expectation is, but it's a very dynamic situation out there in the globe, and it is very hard to predict the situation as we go forward. So we treat these parameters, etc., with a certain amount of caution, and we plan our investments and our way forward accordingly. Going on to the next slide, a little bit overview on the key segments that we operate in. The power and grid sector continues to show strong promise despite the challenges here, the privatization which is not going as fast as the government assumed it to be, but there is significant amount of money that is being pumped in for digitization and modernization of the network, so we continue to piggyback on this particular activity. Also, there is a major thrust towards renewables. There's a firm commitment by the government of India to change the energy mix of the country by 2030 and by 2070. So I think there will be continued investments in solar, and we are also planning our product introductions, etc., in line with this trend that we see. Of course, there is a great push for Make in India. We have a factory and we have the technology available to localize products and keep adapting products as we go forward. On the mining, minerals and metals, I think it has been a strong 2 years, but we see some consolidation signs happening in the market as far as cement is concerned, and all over. You would have also heard about some large-scale exits. There will be some conservatism as far as capex is concerned in this segment going forward, and perhaps we would need to brace for that as well. But there is a huge push for sustainability solutions in this particular segment, especially given the nature of the business that it is in. So there are sustainability projects which are being launched by these corporations, and we will definitely benefit from this trend. On the mobility side, which is primarily transportation, automobiles, EV charging, EV equipment, etc., I think there are very positive signs, infrastructure build-up across the country, both in terms of road, metros, EV charging facilities, etc., and we are well poised to be a very strong player in this segment as well. The data center segment continues to be strong. We see more and more players coming into India, and there is a huge build-up of data centers happening in India. And these are also sort of electro-intensive, and we see that these macro trends will benefit the country as we go forward, and the company as well. Going on to the next page, which is page number 5, I think the entire story around Schneider and its push towards sustainability is to make sure that more and more products that we have are digitized, connected, connectable, sensorized, etc., to make sure that we leverage big data across these products and be able to optimize solutions for the customers, move from more of a reactive maintenance to more of predictive maintenance, and use apps and analytics to be able to succeed in this particular segment. And we have a basket of softwares which are primarily Schneider softwares, which we can leverage to be able to be part of this journey, and we are preparing our equipment also to be in line with this journey. So going on to some of the wins that we have on the digital wins, we see that there is a very good project which we are doing for a large cement company on the waste heat recovery. As I told you, there are sustainability trends in cement industry which cannot be ignored, and there will be capex flowing into this particular segment to make sure that the segment is more sustainable as we go forward, and we have a good play with our equipments as well as digitization offers to be able to succeed in this particular area. Going on to slide number 7, here is another repeat order from a defense facility for one of the submarines which was equipped by Schneider panels. There is a large pull-through. This is the second order of a large magnitude which has come to us in the previous quarter, and we continue our story on services here positively. Going on to slide 8, some of the emerging segments that we spoke about, wins in the EV charging segment. It's still nascent to begin with, but it's a strategic area, and we are focusing here to make sure that we enable our entire suite of products, connected products, as well as the various softwares and microgrids to be able to succeed in this particular segment. We have prepared ourselves with a small team which is working on the conceptualization and the follow-through for this particular segment. With this, I hand over to Mayank Holani, who is the CFO of the company, to give you a little bit of a financial update. Over to you.
Thanks, Sanjay, and good afternoon, ladies and gentlemen. So our order intake for the quarter stood at 3,680 million INR for the quarter, which is up by about 27.5% over last year's same quarter. And this growth is mainly driven by cloud and service providers and mining, mineral and metal segments. And as a result of this good order growth, it has helped us in improving the backlog by about 8% versus the March 22 quarter. So in last 3 months, we have built up additional backlog of about 8%. Sales for the quarter grew about 28.9% at 3,715 million INR. With in terms of segments, it was a mixed bag, some positive, some negative, but there has been a good getaway. We remain cautious in terms of order booking with respect to the terms and conditions, payment timelines and all, to ensure that our margins and cash is secured and we don't risk on that. Further on, we'll move on to the next slide to give you an overview on P&L. Slide number 11, please. Okay, so sales, as we discussed, this additional sales and with the improvement in mix, we have been able to improve our gross margin by about 2.2% versus previous year, same quarter. And our net profit for the quarter stands at 138 million, before exceptional item 138 million, versus a loss of 161 million in previous year. So that's a delta of about 9.3 points. And exceptional item which you see here is a kind of the loan B-class loan adjustment to the fair value adjustment as based on the extension of loan which we have done, which was already existing loan. So that's a notional gain recorded in accounting. So the net profit after tax is about 264 million versus 161 million loss in previous year. This quarter was also impacted by raw material inflation, and while we continue to pass on, to the impact to the customers as and where possible, so partial impact is going to customers, partial is impacting the P&L. But I can say that we have been managing it pretty well in the circumstances which are there, considering the price hike, raw material shortages, and the hedging, etc. With this, I will close here and leave the floor open for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who would like to ask a question, you may press star and 1 at this time. The first question is from the line of Aditya, an individual investor. Please go ahead.
Yeah, hi, good afternoon. I'm Aditya. And my question here is, what is the current backlog at Q1 22?
So our backlog as of end of June 22 is 10,079 million INR, or about 1,008 crores, versus 9,332 million at the end of March 22.
So backlog has increased.
Yes, about 8% increase versus March.
And how are you placed in terms of supply chain now?
See, supply chain situation remains challenging. So electronics are still not normalized. Then due to the Ukraine conflict, there have been challenges on couple of other commodities also, like some specialized steel and all. So it's we can't say that it's normal.
Okay. Got it. Thank you.
Thank you.
Thank you. The next question is from the line of Anurag Patil from Roha Asset Management. Please go ahead.
Thank you for the opportunity. Sir, if you can briefly touch upon all the 4 segments, how do you see the order inflows panning out in the next couple of quarters? That would be helpful.
You mean the mix? Right?
No, sir. How is the situation, means order inflow, whether you are expecting stronger inflow in any of these segments, particularly if in the mining and metals, are you expecting any slowdown due to metal price correction, etc.? That would be.
Sanjay, you want to address this?
Yeah. So we did touch upon this topic briefly. It is not because of the softening of pricing that we see that. See, India has requirement for infrastructure. So basically, the strong drivers for growth is infrastructure demand, right? So, but we see that there has been good amount of capex formation and investments into the cement sector in the past few quarters. So we might see a little bit of slowdown if the infrastructure growth does not keep pace. So that's the kind of outlook that we have. It's too early to say for sure.
Particularly, sir, on the metal side, are you expecting any delays or postponement of capex? Because some of the large cap goods companies are kind of witnessing such kind of delays.
See, if you see metals has been kind of there has not been a lot of fresh investments into metals in the past few quarters, if you really see. So we don't see a material change.
Okay. Thank you. Sir, next question is on the gross margin side. So do you think these kind of a gross margins are sustainable going forward, or any color on how the raw material prices are panning out for us? Are you witnessing any correction in this?
See, this is, obviously this margin, which you see, current quarter is a bit higher than the average for, last couple of years also, probably because of the mix, right? So this is obviously a little bit higher margin than the mix. But yes, in this, already there is a impact of raw material inflation factor. So if that normalizes, then we should see a better margin. But our continuous focus is on improving the mix. So the margin improvement comes from two. One is the pricing, but it's always a competitive market. But we continue to focus also on improving the mix, which helps the P&L.
Okay, sir. Thank you very much. I will come back in the queue.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is from the line of Virat Ali from Jupiter Financial. Please go ahead.
Yeah. Good evening and congratulations on outstanding numbers. Can you give me the breakup? What is our order book size and breakup segment-wise?
So, order book size at the end of June, as I mentioned earlier, is about 1,008 crores.
Okay. And can you give the breakup of the segment?
Breakup of this segment is about system 64%.
Okay.
Transaction 22, services 14.
Okay. Now, the next question is, we talked about in the presentation defense and everything. What kind of play we do have in defense? Like, can you give more color on that? Like the submarines which you mentioned.
If you would say, it is because of the installed base in the submarines that we are getting the pull-through revenue. So the concept that we are trying to tell you is that we are focusing not just on the capex businesses, we are focusing on the life cycle revenue that a capex can generate over, say, 15-20 years of time. So one of the levers is spare parts, the other lever is software and analytics, and the attachment that it brings to your services revenue, and through analytics, the pull-through parts that you can generate.
So it will be broadly a service-based revenue, right? It's fair to assume that.
Broadly service-based revenue, you're correct.
Okay. And this is on the submarines supplied by the France or something like that? Or
yes, this was a submarine that was supplied outside the country, fitted outside the country, but however, since it's in India and the responsibility for the services is with us, we are continuing our relationship with the customer.
What would be the order size? Like, if you give me some color, what is the scope of this business?
Actually, without customer permission, we are not allowed to divulge financial details into public domain. That is the reason why we are not giving you the number, but it is pretty substantial.
All right. And sir, in your presentation, you talked about software. Are you referring to EcoStruxure by any chance in the software?
Yes. EcoStruxure. EcoStruxure, as you know, has different domains. Okay. EcoStruxure is not just one product. EcoStruxure is the generic brand name, but EcoStruxure has a different products for power and grid, different products for transportation. Some of the elements could be common, some of the elements could be different. So there are a number of suites within the EcoStruxure.
And so how will this revenue plan out in terms of services or how? Like, I understand we take from the parent and we pay something to the parent, right, for this software services, right?
Yeah, we buy the product. So it's a license basically, right? It's a license that you buy from the parent. Okay.
Okay.
And then you sell it to your customers. Okay. So there are two kinds of softwares that are available. One that are hosted on the cloud and one that is hosted on the edge. What I mean by edge is on-prem, on the premises of customer, which the customer uses without any help from our side. There the pull-through revenue happens in terms of the upgrades that you are able to bring to the table. For example, if you have new enabled features, etc., you can sell an upgrade to the customer. So that is the services revenue that comes about. There are certain softwares which are on the cloud, which provide analytics. So here is an opportunity for us to partner along with the customer and be part of his journey, to be able to provide him insights on what he needs to do better on the maintenance side, what is going to fail tomorrow that he should replace today to prevent a downtime. So these are value-added services that you can sell.
Is it a transaction-based revenue or it is a fixed price contract with that customer?
No, it is not it's neither transaction nor fixed price. There is a portion which will be fixed price, which is your consultancy services, and there is a portion which comes, which is on demand, on what you will replace or what you will assist him with, which is based on offer to offer.
And the revenue which comes in is shared with the parent, right? So both of us share the revenue. That is true, right? Is it the right way to think about it, right?
The services revenue and the analytics revenue, etc., are most of it in the country itself. It's all within the country, within the business. It's only the cost of the license that you need to pay them at when you are procuring the product.
Thank you. I would request Mr. Masani to rejoin the queue for follow-up questions. The next question is from the line of Kasab Bobna from DMSPL Capital. Please go ahead.
Yeah, hi. Can you hear me?
Yes, we can hear you.
Great. So on page 5 of your presentation, you set up...
Before we proceed, I'm so sorry to interrupt you. Can you please come on the handset mode? I think you're on speaker, so it's not very clear.
Okay. Yeah, now can you hear me?
Please come on the handset mode and come closer.
Yeah, you can hear me now, right?
Yes, now it is clear. Please go ahead.
Perfect. Yeah, hi. So basically, on page 5 of your presentation, you list out 4 segments, right? Power and grid, mining, mobility, data centers. So out of the 370 odd crores of quarterly revenue that you've done, is there any way you could break up the revenue split for these 4 segments? And also, where do you see these segments in terms of growth in the next 3 to 5 years? Which segment do you see growing faster than the other? Could you give some sort of color over there, please?
So we do not provide guidance by segment and a breakup to that detail, but I could give you a certain, color on the overall market dynamics.
Okay, that'll be good.
Okay. So if you see data centers, they would have a CAGR which is in excess of around 12 to 13%, even at a very pessimistic level of estimates. Okay. And a segment like power and grid would have something like a 6 to 7% CAGR because of the base revenues itself being so higher. Whereas something like transportation would be somewhere around 8 to 9%, and cement and steel, etc., are in spurts. It's very cyclical. So let's say over a 3-year time frame, it could be around 7%.
Okay, but what I'm basically trying to understand is how much of your total revenues is the cement and steel portion, because that's the cyclical part. So is it fair to assume it's less than 25-30%?
It's less than that, because if you really see, the largest driver for this business has always been the power and grid segment. So I would say that the dependence on cement and steel would not be in excess of 15 to 20%.
Okay. Great. Thank you so much.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question at this time. The next question is from the line of Aditya Diora from Digresha Investments. Please go ahead. Aditya Diora, your line has been unmuted. Request you to please.
Am I audible?
Yes, you are.
Yes.
Yeah. Good afternoon, sir. Sir, over last 8 quarters, our performance has more or less turned around. So, sir, can we attribute a part of the performance to the L&T, to the acquisition of the L&T electric and automation business by the group? Are we seeing any synergies from that end?
So,
Member, sir. Yes, go ahead.
the L&T business acquisition has taken place in other entity, right? Not in this entity. So directly, there is no relation. So that business is anyway largely in other product lines, right? They are not present in the product which we are dealing in this entity. But obviously, some synergies do come in as get a bigger size as a group. But it's not, can't be said that, okay, it's due to the that acquisition by the group.
So, sir, what will you attribute the reason for the turnaround? For last 7-8 years, we were not performing very well, but something has changed over last 8-10 quarters inside the company.
See, it was, the actions were continuing and it has been a slow and steady progress. So if you see last year, but in between also, I would say a year was wasted due to the COVID also, right? The COVID wave came in, then obviously we saw a drop in revenue. So if in the financial year 19-20, but then obviously our focus has always been on improving the terms and conditions, picking up the right orders, and securing cash, because a big problem has been in this business earlier. If you have been checking on the sales or the bad debts, right? The collections which we were losing and had to provide for in the P&L. And then we have been working on the operational efficiencies as well, right-sizing the organization and restructuring wherever required as per the market conditions. So that has started showing result. And then the volume obviously plays a role. And what we need to also keep in mind that in last 1.5 year it has been quite turbulent in terms of raw material inflation and all. And this performance is really kind of, I would say, well in a sense that managing the inflation and then delivering a profitable result is a big part, because your contracts are on fixed price, right? They are not large majority is on fixed price. So that way it has been good, and had it been a normal year, it would have been even better.
But in answering to a query of one of the previous participants, you were mentioning that we should not see just how much revenue are we or how much profit margin are we making from one particular project. We should see life cycle revenue. So, sir, incrementally year on year, do we see the services and the spare part improving in our revenue, in our total revenues as a percentage of our total revenue?
If you have been tracking services. Share in our mix has been improving over last many years, right? Not just in 2 years. So slowly and gradually services share has been improving. But obviously it's not a drastic change that suddenly it will become, say, from 10 to 15% or 15 to 20, because this industry is like that where people don't take too much of service contracts, unlike some other industries. But gradually the service share has been improving. Year after year.
The services revenue is at a higher margin, right, as compared to the initial products that which we supplied?
Obviously, yes. Services obviously comes at a higher margin.
So coming to your presentation, on page 8, you have mentioned about emerging segments are wins, some EV charging infrastructure work or something that we might have done. Sir, can you just elaborate what we have done or what we plan to do in this particular segment?
What's going to happen is that we are going to move away from a centralized generation and distribution of energy to more of a distributed generation and a prosumer effect, where a consumer of electricity will also be a producer of electricity. So you could see many charging stations, etc., where you would have a mix of power usage, which is a mix of what you take from the grid, which is your conventional energy, and some of its own solar generation as well. And then you would have the EV charging associated with this. So all this presents a very solid opportunity for electrification A, be digitization, because of the fact that when you're using mixed sources of energy, you will not be able to manage the grid very efficiently without software. And C, because of the sheer scale at which EV will grow in the country, this will require a very large amount of focus in terms of infrastructure development. So all these presents a very good opportunity for electrification and digitization, which is our core focus areas.
Sir, have we got any orders in this particular segment as of now?
So right now, I would not like to talk about the wins. It's a little bit premature. So we will share more details with you as we go forward.
Okay. Thank you. Thank you, sir. Thank you so much.
Thank you. The next question is from the line of Nikhil Jain from Galaxy International. Please go ahead.
I just wanted to actually check the order that we have of around 1,000 odd crores. So what is the time frame in which it is to be executed?
See, typically, depending on the, for different products, the time frame ranges between 3 months to 10 months, 8 to 10 months. Typically, based on the product time, and some one-off contracts may have even a longer period.
Right. So for simplicity's sake, can we take, let's say, around 6 to 7 months on an average? Some projects higher, some projects lower.
Yes.
Right. Okay. And second thing is that once we take an order, and especially in the longer dated order, so is there a clause for raw material escalation or is it like kind of fixed?
See, we obviously want to have a price variation clause in each and every contract, and we push for that. But sorry, it depends on the customer conditions and how the competition is also going. But largely contracts are fixed price.
Largely contracts are fixed price. Okay. So if the raw material prices fall, then whatever if that gives us a benefit, we can retain that and vice versa. So if they rise, then whatever hit we have to take on the EBITDA margin, we take that, right? More or less.
Yeah, but it will be a kind of mix, because what happens is you are doing hedging. So if prices fall, you get a loss from the hedging, and then also you don't see an immediate result, right? Because if I am ordering today, I am getting material after 2 months, 3 months. And it's a mixed bag, right? So still some commodities are going up, some are coming down. But yeah, largely on a long run, if it will get, it should not be too negative.
Okay. Okay. The next question I just wanted to ask was that we were referring in the opening remarks that there are some new products that we are kind of introducing. So is it like possible to give some color on what are the kind of products in which area segments we are doing that?
Bit on the solar piece, where we would be introducing certain products to be more able to cater to that segment and the growth in that particular segment. We also see a very strong growth on the ring main units, etc., given the infrastructure growth in the country. So we'll be introducing some products around those areas as well. And we'll be happy to share with you the progress as we go forward.
Sure. Okay. And one final question, and that I actually wanted to get not a guidance, but basically some kind of a qualitative view from yourself on, let's say, what's the kind of, let's say, revenue growth, let's say, we look forward to, let's say, over a period of, let's say, 2 to 3 years, right? So are we saying it is possible, or it may be possible to grow by 10-12%, or we will aspire, not possible actually, aspire to grow by this much, aspire to grow by that much, and also on the EBITDA margin. So what would be the kind of EBITDA margin that you actually aspire to get to? Because it has been very variable, right? From 0% to, let's say, 7% in some quarters to 12-13% also. So I just am trying to understand what may be kind of, let's say, modeling perspective, what can be the reasonable EBITDA margin which management could actually be looking to get to?
See, we generally don't provide any guidance in terms of future revenue or margin. But just would like to give one comment, because here the quarter we are comparing, last year Q1 was an exceptional one with, infected by the COVID second wave, right? So that has also impacted the quarter. But as far as guidance is concerned, we don't provide any guidance for future.
Right. I understand that. I appreciate. So, but the only point that I was looking for is, let's say, in this business that we are doing actually, right? So what's the some kind of a aspirational margins that we have, right? Which we are looking for, whether 10% is good enough for us, we are targeting 15, or we will look at 8 is good enough for us. So something like that is what I'm just trying to get a hang on. Like, no guidance per se, not on a quarter-on-quarter or year-on-year basis. So at least a direction in which, yeah.
Won't comment on that, but would only say that, okay, we will obviously not be looking at a margin from quarterly perspective, or, because quarter on quarter, sometimes this is a project business, so the numbers may fluctuate, right? The volumes may fluctuate, and that directly affects margin.
Okay, fair enough. Thank you. I'll join back with you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question at this time. The next question is from the line of Manish Goyal, an individual investor. Please go ahead.
Yes, thank you so much. I would like to just get more perspective on the revenue mix change, what we have mentioned, which has led to improvement in gross margins and EBITDA margin. And also, what we see is that other expenses have actually declined YOY despite strong top line growth. So just if you can probably give more perspective as to how sustainable it is, and maybe if you can share the revenue breakup on systems, equipment, and transaction products, that will be helpful.
Yeah. So Manish, the revenue breakup for the quarter, if you see, this quarter has been system 69%, transaction 21%, and services 10%. While if you look at last year's same quarter, it was 75% for systems, 17% for transactions, and 8% for services. So about 4% increase in transaction and 2% in services. So that is the mix change which I was mentioning. And also there was, within equipment also, there was one product line, there was a change, some decline product which was giving a lower margin. That also helped in the margin difference. Now on the second part of your question, if you see other expenses, it's mainly the savings coming from savings for the old debts recovery, which has reduced the expenses. So old debt recovery and the forex gain. So these are two items which have reduced. Otherwise, the expenses which are directly linked to volume, be it freight or travel. Last year there was not much travel in this quarter because of COVID. So travel has gone up, freight has gone up, trademark fees linked to volume, that has gone up. But the rent, as there was some savings, obviously it's a part of the continuous focus on cost savings. And then the old debts correction and forex are the major items which have negated all the impact of increasing cost. And overall you see the lower other expenses.
So, would it be possible to quantify how much recovery and forex gain we had in the quarter?
So that is about if these two items you add together, it's about 75 million.
Okay. And Mayank, just maybe if you can probably get, so I just want to get a better perspective on this 1,000 crore order book what we have. So is it possible that the kind of gross margins what we have seen, based on the current order book, we are more or less likely to remain near these levels?
So you see, our order booking margin as such has not changed drastically. So on either side, so it's continue to be in the similar range.
No, where I'm coming from is that what improvement we have seen due to better revenue mix and as mentioned in a presentation on improvement in productivity. So, do we see this trend continuing going forward?
So see, I think this mix change is, too wide. So that exactly, while we continue to focus on improving the mix, and you have seen a gradual improvement in services mix and transaction, but exactly this kind of mix may not continue. It can keep fluctuating quarter on quarter.
Okay. But broadly, directionally, we see that our margins should be on a improvement trajectory.
Yeah, see, last year anyway was a exceptional year in terms of raw material inflation also, right? So because margin is also a derivative, which is something not completely in your hand when you have a fixed price contract, right? So if that should improve, give us benefit on margin.
Can you give me the intergroup revenue number for the quarter and also for the last full year?
So, IG revenue. So, IG revenue is 22%. Is about 22%.
For the quarter?
Yeah, for the quarter.
So what would be the order inflow number for IG?
Order number?
Order inflow number. Or is it that the revenue number is similar to the order inflow in the IG category?
So order absolute number, if I tell you, is for the quarter, it's about 780 million. 78 crores for the quarter.
Do you have number for last full year, FY22? What was the IG revenue?
Last full year, just give me a second.
Last full year, order intake number is
Asking for revenue number.
This 15, IG number is 23% roughly.
So it was 23%, Manish.
Okay. Okay. Thanks, sir. Thank you so much for all the answers.
Thank you. Thanks.
Thank you. The next question is from the line of Suraj Nanda from ICICI Prudential Mutual Fund. Please go ahead.
Yeah. Hi, sir. So I just wanted to understand, like, what in the mix, how much is projects and how much is products?
Sorry, can you repeat your question?
Yeah. In the mix, how much is projects, how much of the revenue is coming from projects, and how much is the products?
Okay. So, I think I mentioned earlier, so on sales, our transactions is 21%, services 10%, projects in 11%, equipment 36%, and IG 22%.
Okay.
So which together we call a system, 69%.
Okay. Okay. So projects is only 11% is what you're saying?
Yes.
Okay. And sir, on the borrowing side, we see that the debt levels is pretty high, and a major part of it is through, loan from the sister entity, I think, Schneider IT Infra, I think something.
Yeah.
So how are we planning to, reduce the debt, and as a result, the interest component in the
the debt, if you see from last year, in last financial year, from March 21 to March 22 also, if you had seen in the annual report, and the financials, that has improved, right, with the improved collection. So the way is to improve the operational performance, get profits and cash in hand. So that way only we can reduce the debt. At this stage, we don't have any other plan to reduce the debt.
And has the payment scenario for you improved in terms of days?
Yes, it has improved in terms of days, definitely, because and that's what reflects in our cash flow also. If you had seen the last quarter call or last financial results for the full year, our cash flow from operations was about 120 crores versus, I think, 6-7 crores in the previous year. So there has been a significant improvement in the collections and the cash realization last financial year. And the same trend continues in this quarter as well.
Okay, okay. And are there any, capex plans for, indigenization or anything, or the entire cash flow generation will be used for, maintenance CapEx and paying back of debt?
No, at this stage, nothing specific or major CapEx finalized or in plan.
Okay. Thank you, sir. Thanks a lot.
Thank you. The next question is from the line of Viraj Mithani from Jupiter Financial. Please go ahead.
Yeah, thank you for the opportunity again, sir. My question is, have we stabilized in terms of raw material prices by now? Like, what's your sense on the market? Are we seeing some stability coming there?
The raw material prices continue to fluctuate. I mean, it's difficult to say or forecast anything. So even if we look at last quarter, some commodities prices declined while others were going up. So, for example, copper prices they have declined in last some time, but CRGO steel has been going up, or the transformer oil has increased a lot. So it's not one way for all the commodities.
So the next question, what is our capacity right now? What capacity you are working at right now would be, right?
For transformers?
Generally, capacity utilization would be what? Like transformer, other things?
Plant capacity?
Capacity utilization of the plant.
Yeah, so that has been, I can say in the last quarter, it has been about, I think 85 to 85%.
Okay. And my last question is, we price our products into euros, right? And then to the dollars. So are we benefiting by the euro becoming weaker to the dollar?
No, we don't. Our products are mostly sold in India, so those orders are all in INR.
No, imports which are there.
Yeah. Okay, so imports, obviously, imports are in euro or USD, depending on the country. So what was your question on that?
Means, do we benefit from the euro weakening? That's what my question. So.
Yes, see, that's what I was, when I presented I was answering, I think, Manish's question. You must have seen, we have a forex gain in the last quarter. So that depending on, the fluctuation, some quarter you will see a gain, some quarter we have loss. While we hedge also the forex to some extent, but it's something, not always in your control.
Okay, so thank you and all the best.
Thank you.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is from the line of Harshit Kapadia from Elara Securities. Please go ahead.
Thanks for the opportunity, sir. Just wanted to check with you on the semiconductor shortage. So now has the issue been now getting lower, or you still face the issue on semiconductor shortages? And secondly, any color you can give on the recent announcement of the revamped distribution scheme? Do you think that scheme is going to benefit the Schneider Electric at large, and you will see power grid growth, which you mentioned 6 to 7%, can move to double digit?
Take the later half of the question. The first part mine can take. The later half of the question is more towards power and grid. I do appreciate that the power and grid segment is quite a large segment in India, and a 6 to 7% growth, especially driven by modernization of the segment, presents a very good growth opportunity. And we will definitely benefit from the scheme that you are talking about, which is more around digitization and cutting losses in the segment.
Sorry, the line was not clear. What was your first part? It was around, I think, semiconductors, right?
Yeah. Do you still face the semiconductor shortage issues?
Yes, it continues. So the supply is limited and not exactly as per the demand.
So do you anticipate any impact on revenue in the coming quarters, or right now you have sufficient inventory at your backlog, so there should not be much impact?
No, see, that impact is there, and I mean, if we get semiconductor electronics completely as per our demand, definitely revenues can be better. But the impact is there.
Okay, fair enough, and all the best. Thank you.
Thank you. As there are no further questions from the participants, I now hand the conference over to Mr. Harshit Kapadia for closing comments. Mr. Kapadia,
Hi.
you may go ahead.
Sorry. We would like to thank the management of Schneider Electric Infrastructure Management for giving us an opportunity to host this call. We also thank all investors and analysts for joining for this call. Any closing remarks, Sanjay sir, you would want to give the investors?
I'd like to thank all of you for your continued support and for joining this call and listening to us. Have a good day, please. Thank you.
Thank you. On behalf of Elara Securities Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.